Welcome back to Boring Currency, where we track physical metals, paper market stress, and the forces reshaping the global financial system. Picture this moment clearly. Today is Sunday, February 8th, 2026. While most of the planet is offline, resting, and the major New York exchanges sit dormant, something monumental is unfolding quietly inside the futures markets. The dollar index, the DXY, has officially shattered beneath the 97 threshold. This is not a routine pullback. This is a systemic admission of failure. And the figure that has central bankers breaking into cold sweats is this. Silver is trading at 115 US per ounce. But pause for a second. The most unsettling detail is not the metal's price. It is the eerie stillness inside the equity markets. Silver mining stocks remain frozen, valued as if silver were still languishing at $50. I need you to act right now. Shut down your entertainment apps. Close every social media tab. What I am about to show you is not speculation. It is ignored mathematics. This is a generational wealth transfer unfolding in real time. Where are you watching the breakdown of fiat currency from? New York, London, or Shanghai? Drop it in the comments below. Now let us perform a forensic autopsy on current market valuations to expose why the mining sector is the most grotesquely mispriced asset class on Earth. Ignore the flashing green and red ticker lights. Focus instead on the operational math. This is where the real investigation begins. And once you see it, the disconnect becomes painfully obvious to anyone capable of basic arithmetic. The market is suffering from extreme cognitive dissonance. It acknowledges silver trading at $115 an ounce, yet values the companies extracting it as if the metal were still priced at $50. Why does this distortion exist? Because the average investor, and the algorithmic trading systems dominating Wall Street, are programmed to worship mean reversion. They are betting this price surge is temporary, a bubble destined to implode and send silver crashing back to $30. They are paralyzed by the fear of buying the peak, terrified of a pullback, and completely blind to the structural transformation in profit mechanics. Let us dissect the leverage of a silver miner, the hidden weapon of the resource sector. Rewind 2 years. Visualize a primary silver producer when silver traded near $30. To extract 1 ounce, blasting rock, crushing ore, refining metal, paying labor, the cost averaged roughly $20. This is the all-in sustaining cost. At $30 revenue and $20 cost, profit equaled $10 per ounce, a 33% margin. Respectable, but unremarkable. Now fast forward to today. Silver trades at 115. Skeptics argue inflation raised mining costs. Diesel is pricier. Labor demands increased wages. Steel inputs cost more. They are correct. Let us be generous and assume mining costs climbed from $20 to $25, a 25% increase. But now examine revenue. The metal price surged from $30 to $115, nearly quadrupling. Here is the number that breaks the system. Revenue is $115. Cost is $25. Profit becomes $90 per ounce. Pause and absorb that. At $30 silver, profit was $10. At $115 on silver, profit is $90. The metal price rose 4 times. Profits exploded 9 times. This is operational leverage. It is non-linear, it is exponential. Now look at mining stock charts. Are they up 900%? No. Most are up 200% or 300% at best. They lag far behind the economic reality of their own balance sheets. Markets are pricing fear instead of cash flow. This disconnect creates a vacuum, and vacuums never remain empty. They fill violently. Investors sit on the sidelines waiting for silver to retrace to $80 or $70. They stare at charts from 1980 and 2011, assuming history must repeat with a devastating collapse. But they fail to understand the nature of this rally. This is not speculative leverage on COMEX. It is not market cornering. This is a currency failure. Silver did not rise because it became more valuable. The dollar lost integrity. Silver is the thermometer measuring monetary fever. Mining costs remain denominated in fiat currency. Revenues are repricing in monetary reality. The result is margin expansion unlike anything seen before. Consider upcoming earnings. These miners will report cash flows that embarrass the technology sector. Debt will be erased. Massive buybacks announced. Dividends yielding 10, 15, even 20% at current valuations. And when those numbers hit the wires, algorithms will break. Quant funds hunting yield will have no choice but to buy. Pension funds desperate to outrun inflation will be forced to allocate. But here is the fatal bottleneck. The door is tiny. The combined market cap of all primary silver miners is smaller than a single mid-tier tech stock. When billions attempt to enter this sector, there will be no supply, no sellers. Why sell a company minting cash? The repricing will not crawl upward, it will gap. Overnight doubles, no liquidity. We are in the disbelief phase, the most dangerous stage for the uninformed and the most profitable for the prepared. The crowd believes prices are fake, manipulated, destined for confiscation. Haunted by past bear markets, they invent excuses. Meanwhile, silent capital accumulates relentlessly, focused not on price but forward earnings. Mining is a depleting business. Every ounce removed is gone forever. Usually punished, but during currency collapse, underground reserves become priceless. The market currently assigns zero value to in-ground silver. That changes when the dollar does not recover. Valuations will be rewritten ounce by ounce. This is how 10-baggers are born. Ignore daily noise. Ignore $5 swings. Focus on margins. That spread is lethal for shorts and generational for longs. Now dismantle a dangerous misconception. Wall Street treats all commodities equally. Wheat, oil, copper, silver, same rules. Price rises, supply responds. This assumption collapses when applied to silver. A farmer can switch crops in months. Silver cannot be planted. The easy deposits were mined decades ago. Ore grades collapse yearly. Even new discoveries take over a decade to reach production. At 115 today, supply arrives in 2036. Until then, nothing changes. Worse, 70% of silver is a byproduct of copper and zinc mining. If the economy slows, base metal production falls, and silver supply vanishes regardless of price. Even $500 silver cannot force copper mines to reopen. Industrial demand is inelastic. Solar panels, EVs, AI chips all require silver. Substitution is impossible. Cost increases hurt margins but cannot halt consumption. Corporations bypass futures markets and hoard physical metal. Premiums explode. Delivery delays stretch into months. This is the commodity trap. Paper promises collide with physical scarcity. When industry realizes contracts mean nothing without metal, they will buy mines. Vertical integration begins. Mining equities become strategic assets. We are witnessing the largest capital rotation in history. Institutions abandon the 60-40 portfolio. Bonds fail, stocks fail, cash decays, commodities remain. Global pension funds hold virtually zero silver. A 1% allocation would consume global supply. Family offices move first, endowments follow, sovereign funds end the game, liquidity disappears, index buying accelerates, passive flows reinforce the move, melt-up dynamics take hold. This is not hope, it is arithmetic. Currency debasement is inevitable. Capital migration is irreversible. My final strategy is simple. Do not sell early. This is not a trade. It is a repricing of collateral. Mining equities could rise 10 to 20 times from here. And if you want more sharp updates like this on boring currency, subscribe and comment boring currency so I know you're part of the community. This video is for education and discussion only. I'm not your financial advisor. I don't know your personal situation, and nothing here is a buy or sell recommendation. Do your own research and think for yourself. Stay safe.